Hello and welcome to Economics A-Level on YouTube. In this video we're going to look at the economic or business or trade cycle. In the last video we looked at an introduction to the basics of macroeconomics and the map of macro. So if you want to go back and look at that again, please click on the link now. In this video we're going to look through the phases of the economic cycle and the characteristics that each phase has got, and then we're going to link the economic cycle graph to other parts of the micro and macro course. So this is the economic or business or trade cycle. They're interchangeable terms, and as you can see, the cycle shows how the economy moves from a boom period through downturn to a recession or depression, and then back through recovery and back to boom again. It plots actual GDP against trend GDP, and the actual GDP is just the current level of GDP in the economy. The trend GDP is the long-term prediction of what GDP is going to do over the long term. So here's the economic cycle graph again with positive and negative output gaps put on them. So we need to briefly talk about the positive and negative output gaps. We begin with a positive output gap. This is where the actual level of GDP at the moment in time that the economy is operating at is above the trend level, the long-term prediction of what GDP should be growing at. So in this phase, the economy is overheating and there is what we call an inflationary gap where there's high levels of inflation and the actual is above the trend GDP. A negative output gap, as the name would suggest, is the opposite. So this is where actual GDP is below trend GDP. This will typically happen in a recession or depression, but part of a downturn phase will start entering into what we call a negative output gap as well. So you can see that on the graph there. So during a negative output gap then, actual GDP is below trend GDP. You can see that here. So part of the downturn phase will be part of a negative output gap. And certainly when we get into a recession or a depression, then we've got quite a large negative output gap. This is also called a recessionary gap. The big risks of a negative output gap are something called hysteresis, which is where labour loses its skills over the long term when it's unemployed for a long period of time. So for example, think about a teacher. If they've not taught a specific subject for a long time, they've probably forgotten the concepts, they'll have lost their skills in that, and that's what hysteresis then, but on an economy-wide scale. It also happens with machinery. If you've not used a piece of machinery for a long time, it might have rusted and lost what capacity it did have for production. There's also a big risk in a negative output gap of deflation, which is where consumers hold off spending, expecting price levels to fall further, and therefore that creates a downward spiral in the economy where consumption falls further, prices fall further again, people hold off more consumption waiting for lower prices in the future, companies go bankrupt, unemployment rises and so forth. So people think deflation is a good thing, but by and large it tends to be quite a negative thing. So they are the positive and negative output gaps. We're just going to talk briefly through each of the characteristics. So during a boom phase then, you'll have GDP growth levels quite high, unemployment levels low, the economy tends to be at or near full employment. In the short term, we can be beyond full employment, so workers working overtime and so forth. Inflation will tend to be high from the demand side, so perhaps even above the UK's 2% target. And of course, cost push inflation can be quite high during a boom phase as well if there's pressure put on the demand for raw materials. The current account of the balance of payments, well, that depends on whether the country's a net exporting country. In a boom phase, level of exports can be quite high because the businesses in the economy will be producing quite a lot of products to sell abroad, but also at the same time, import levels will be quite high because consumers got more disposable income because there's more employment, and therefore they'll spend on more expensive and perhaps more luxurious foreign products. The budget position of the government should tend to be in surplus during a boom phase of the economic cycle, so there should be high levels of tax receipts from all that increased spending, from VAT, from corporation tax, from business profits and so forth, and low levels of government spending because the private sector is buoyant, it will be doing the spending. So that's theoretically what the government's budget position should be, although under the last Labour government in the UK, the government's budget position when in a boom phase up until about 2008 was still to be spending more than it was taking in over that period of time. Consumer incomes will be high because employment levels are high. Business profits will be high because there's lots of consumer income and lots more consumption in the economy, and therefore that's driving more employment as well. And therefore, because businesses have got more profit, they'll have more retained profit, which is profit after corporation tax, and therefore business investment will be high. Overall, business and consumer confidence will be high because of job security and increased incomes. So moving through to a downturn then, we start to see a moderation in all of the levels of GDP and unemployment and so forth that we saw in the boom phase. So in a downturn, GDP growth rates will start falling. So they may still be positive, but they'll be lower than they were during a boom phase. Unemployment will start to rise, demand side inflation starts to fall, and the current account again depends on exports and imports, but if factories start producing fewer goods and services, cutting back on production, there may be fewer exports, and if people become unemployed, they're going to spend less on imports because they tend to be more expensive. Government's budget position might now start to run a budget deficit in order to try and prevent a recession happening, and consumer incomes will fall because unemployment might be rising, business profits will fall because consumers therefore with lower incomes will do less spending in the economy, consumption falls, businesses start to scale back investment as a result, and business and consumer confidence starts to fall as well. On to then a recession or depression, also known as a trough or slump. So let's first of all just state that a recession has a technical definition where GDP is negative for 2 or more consecutive quarters. In other words, it has to be a minimum of 6 months back to back of negative GDP to be counted as a recession. A depression, on the other hand, is just a severe and prolonged recession. So 1929 to 39 was the classic example of a prolonged recession. You could argue as well that 2007 to 9 or 2007 to 12 was quite like a depression, although commentators and economists are calling it the Great Recession, but it's kind of similar in its effects to the Great Depression, but on not quite as large a scale. Although in some countries like Greece, they suffered quite severely during that period of time. So in a recession or depression then, GDP growth is going to be very low or negative. Unemployment's high. Again, a risk of hysteresis if it's a depression because unemployment will persist for a long period of time. Inflation from the demand side of things is going to be low, although of course you can have high cost push inflation. This is what triggered the 2007 recession in America, the high oil prices at that time. The current account, there'll be low levels of exporting and importing because economic activity will be very low in the country. The budget position of the government's highly likely to be in quite a large deficit. The government's going to be spending in order to try and get the economy moving again to stimulate economic activity. And then in a recovery phase, everything starts to pick up again. So growth starts to rise, unemployment starts to fall because businesses now start to experience more spending and therefore more profitability and investment. Demand pull inflation might start picking up, although it'll be slow at first. And the government will probably start scaling back its level of spending, may still be running a deficit, but the rate of increase of deficit will be slowing down, perhaps reversing, trying to move them back towards a more balanced budgetary position. So they are the characteristics of each phase of the economic cycle then. So just to link the economic cycle to other areas of the course and other concepts, if we just look at the PPF now, if we moved from point X towards the original black-lined PPF, that would be characteristic of moving from something like a recession or depression through to a recovery phase. So the black-lined PPF would be the trend GDP level. Anywhere inside that PPF would be in the position on the economic cycle graph where we are underneath that trend GDP line with the actual GDP, so in a negative output gap essentially. On the aggregate demand and supply graph, where AD is intersecting LRIS, that would be a position of unemployment. So again, that would be a negative output gap, and full employment then would be where actual GDP meets trend GDP or on the PPF. We can be beyond that, we can show a positive output gap on the aggregate demand and supply graph in the short term, but that will be saved for another video. So in the next video, we're going to look at the circular flow of income. So click now if you want to go straight to that one. If not, please click below and subscribe, and see you in the next video.